So, what to do about the tariff-induced market turmoil that we're currently in? It's been 5 days since U.S. President Donald Trump declared Liberation Day by enacting 10% universal tariffs, with 90 nations on the receiving end of additional so-called reciprocal tariffs. The new U.S. tariffs announced last Wednesday varied from 10% to 50%, with large trading partners like China receiving a tariff rate of 34%, South Korea 25%, Japan 24%, and the European Union 20%. Stock markets around the world, though, they declined quickly on the announcement. And we know that there has been lots of news coverage about these tariffs and the subsequent declines in global stock markets. And investors are rightly asking, what's the rationale behind the steep new U.S. tariffs, and what does that mean for their portfolio? What can or should we do as investors? Let's try to answer both questions, starting with why these new U.S. tariffs are put in place. President Trump and his advisors believe that the U.S. trade deficits with other countries are just too high. We do import far more goods than we export as a country. The president's team believes that U.S. goods producers have been put at a disadvantage over the years through other countries, creating obstacles to our goods and services entering their markets. And they believe that if these trade barriers were removed, the trade deficits would shrink dramatically, and that would be good for the U.S. economy. Tariffs are one kind of trade barrier to U.S. exports. The Trump administration announced a base tariff of 10% on all imports, with higher so-called reciprocal tariffs between 10% and 50% for countries deemed to be more unfriendly to U.S. goods. Tariffs are essentially a tax or a duty that must be paid by the receiver of the good when it crosses the border. So here's an example. On imports from Switzerland, the reciprocal tariff announced last week was 31%. If a Swiss chocolate maker fulfills an order and sends inventory costing $4 per bar to a U.S. grocery store, the U.S. grocery store would pay the Swiss chocolate company $4 for every bar, and then another $1.24 per bar to the U.S. Treasury. The grocery store then must determine whether to mark up the chocolate bar to cover the extra $1.24 from the tariff or not. Now, $1.24 doesn't sound like a lot more to pay for a chocolate bar, but what if the thing being purchased is a Volvo? Headquartered in Sweden, Volvo is a member of the Eurozone, which was assigned a reciprocal tariff of 20%. Basically, the tariff on cars imported previously from Europe was 2.5%. By comparison, the Eurozone charges a 10% tariff on the import of U.S. automobiles. Now, under the new 20% reciprocal tariff, if the dealer cost on the vehicle is $65,000, the dealer pays Volvo $65,000 and then must pay the U.S. Treasury another $13,000 when the vehicle comes off the boat. That's $11,375 more than just a week ago in tariff. With $78,000 in total cost to bring the Volvo into the U.S., how much of that additional $11,375 will ultimately be paid by the dealer in the form of reduced profits, or the consumer through an increased sticker price? The third option would be for Volvo to maybe lower their dealer cost. Regardless, the markets have looked at these new, much higher tariffs and quickly realized that companies will be less profitable and consumers will likely be paying higher prices, at least for a while, neither of which bodes well for stock prices or economic growth. Stock markets had been operating in an equilibrium based on previous tariff policies and agreements between countries, pretty much on a good-by-good basis. Global tariffs are complex. In Canada, for example, the tariff on importing a live U.S. chicken is about 50%, but a U.S. auto only sees a 5% tariff. Many imports are subject to absolutely no tariff, especially under the USMCA trade treaty between the U.S., Mexico, and Canada, as negotiated by President Trump in his first term. The bottom line on the new U.S. tariffs is that they are now historically very, very high, the highest since 1930, and very broad, and really none of them have been negotiated yet. Many economists have called the action of the executive branch of the White House a unilaterally declared trade war, while the president's supporters say he is using the tactic to set up later negotiations. Investors can only hope that these negotiations come quickly and are very successful. So how should an investor respond to all this volatility and uncertainty? Well, the first thing is to do a little perspective taking. On a year-to-date basis, the globally diversified investor has seen their U.S. stock market holdings decline into what's called correction territory, which means they're down more than 10% from a previous high. The S&P 500, for example, was down 13.66% in 2025 at the end of the day on Friday. Foreign stocks, which have been leading their U.S. counterparts all year, on Friday closed down 1.75% for the year, based on the MSCI All-Country World ex-U.S. Index. But that is over 10% off its 2025 high point, reached on March 19th. Bonds are doing what we hope and what they most often do when stocks decline. They're holding their own and they're gaining a little bit. The Vanguard Total Bond Index Exchange Traded Fund is up 2.6% for the year through Friday. So while not great news on the stock market front, given the declines of the last week, in the bigger picture, perhaps a little better than some investors would have expected. And bonds continue to provide positive results both through interest payments and appreciation. Reviewing market history also reminds us that most years see at least one 10% or greater pullback in the U.S. stock market. While never welcome at the time, since 1950, the average worst drawdown within calendar years has been 15.4%. Also since 1950, the average annual return was 11.6% to the positive. Of course, there have been plenty of years when the drawdown has been greater than the average, and we'll see how far this current one extends. As of Friday, the drawdown from the 2025 market high in the U.S. stock market stood at a negative 17.5%. Now, the last time the market declined more than average was 2022. Not that long ago, really. With inflation running very high at the end of that year, the S&P experienced a drawdown of 22% before starting its recovery. Before that, there was the COVID-19 pandemic year of 2020, which saw the U.S. market at one point down 34%, before recovering dramatically to close that same calendar year up 18%. Of course, the longer-term picture for stock market investors has been one of tremendous growth, especially if an investor held steady through good and bad times. Some of the very best market days have come on the heels of the worst days. In 2020, the second best day happened immediately after the second worst day. And since 2003, 7 of the 10 best days for U.S. stocks took place during bear markets. In those cases, when the recovery started, you had to be already invested to catch the tailwind. Missing just the 10 best days since 2003 would have cost an investor over 50% of the total return available for that period. That's an amazing number. With the news media in hyper-response mode, it's just hard to keep a level head right now. We understand. And in highly volatile markets, the hardest thing to do is to stay put. But staying invested through thick and thin in a globally diversified portfolio that has been constructed based on your financial plan, well, that's served long-term investors incredibly well and enabled them to realize their goals. This means that for investors who had been planning to take dollars out of their portfolio here in the near term for living expenses, let's say, well, it usually means that there's already a few years' worth of cash and bonds in place to weather stock market volatility just like this. In our view, that wisdom of long-term investing and the experience still makes the most sense. Now, Joe Wiggins is an author of a blog called Behavioral Investment, and he put out a post last week that included a list of do's and don'ts for investors right now. His list is so good that I'm just going to share it. It should sound like things you've heard from us many times over the years. So here's the don'ts. Don't keep checking your portfolio. Don't watch financial news. Don't think you'll make a good investment decision in this environment. Don't listen to people who didn't predict the current market tumult when they try to predict what's coming next. Really, don't listen to anyone predicting anything. We would say, embrace uncertainty. Now his do's. Do focus on your long-term goals. Do remind yourself that equity markets have generated long-term returns despite frequent periods of losses, which are sometimes severe and really which we can't avoid. Do remember that equity market losses always come alongside some very worrying news about the future. Do remember that nobody knows what will happen next. It might get better. It might get a bit worse. Do remember that this is why you hold a diversified portfolio and have a long-term time horizon for the equities in it. We're recording on Monday, April 7th, 2025. It will likely be an eventful week or weeks with many raised voices sounding various alarms around the world. There is certainly plenty of risk and uncertainty regarding short-term market performance, as well as the resolution of this whole tariff turmoil. The Wall Street Journal's Jason Zweig interviewed Brian Taylor, the chief economist at a research firm that analyzes centuries of market data. Taylor said, quote, ultimately, the cost of the tariffs will be recognized and they'll be rescinded. When you look at the past, you see that markets do recover because over time, logic prevails. Taylor's remarks correspond with history. Markets regain their equilibrium and resume their path upwards because people, businesses, and governments are highly motivated to solve problems and to progress. It can be bumpy and a bit unnerving while these problems are being addressed, but we, you and me as long-term investors, have plenty of reasons to remain educated optimists, and perhaps for the coming weeks or months, patient optimists as well. If you have any questions regarding your portfolio or need to talk to an advisor, we encourage you to call Foster Group at your convenience. We'd love to have that conversation. Thanks for listening this morning. Have a great week.